thank everybody for sitting in this episode of Small Space for Young Entrepreneur. I'm your host, Scott Mesha, and today I have a great guy I've been following for the last month or two. His name is Mike Jeshashek. He's the partner and brand ambassador of Inksight Accounting. Hey, Mike, how you doing today?
Scott, thanks for having me. Happy to be here.
Great. So, can you tell my listeners a little bit about yourself, a little bit about your business?
Yeah, so I've been kind of in the accounting and CPA space for quite a while, and really what my intentions are is to try to help business owners understand the tax savings and tax strategies that are available to them. So many people think that tax savings is simply just for the ultimate wealthy and the rich, when ultimately, no matter what stage you are in your business, big or small, there is so much tax savings potential. So it's kind of part of that mission to kind of bring in this idea of tax savings to small business owners. We started our small business tax savings podcast. We do weekly episodes kind of diving into strategies. So that's really our goal, is to just say, hey, how can we provide as much value out there to these business owners that are just kind of going out there thinking that maybe tax savings is just for the rich. We're trying to kind of change that mold and say, no, tax savings, whether you're just getting started or whether you've been in business for 30 years, there's tax savings potential at any level of your business. So that's our goal. We obviously have our small business tax savings podcast. We do tax tips and things like that. And then we also have Inksight, which is our accounting firm on the back end. For any of those that maybe say, I don't want to handle this as much, I don't want to be as hands-on, that's kind of the done for you service arm of our business.
Mm-hmm. So I'd like to ask a few questions, if you wouldn't mind, over this interview or episode, and to maybe deep dive into the tax questions that small business startups or even businesses that have been around for a little bit maybe asking themselves or asking their tax consultants. I think the first one I'd like to ask is how long you've been in business for yourself or for your business.
Yeah, so I've been actually an entrepreneur since the age of 14, and sometimes I'd say maybe even started earlier than that. What happened was my dad used to go into a lot of auctions and buy pieces of something in an auction and then resell it on eBay. This was back in the day. And my first kind of forte into selling my own thing was at a really young age. And he bought this box of bottle caps. They were like bottle caps for an old glass bottle. And they had like a soda name on top of them. I can't even remember what name it was. But he bought this lot of, say, 1,000 bottle caps for $25, something like that. And he gave that to me and he said, okay, this is going to be your project. We're going to take that 1,000 bottle caps. We're going to bag them up into, sets of 50 or 100, whatever it might be. And we're going to resell them on eBay. And so that's what we did. We kind of sold them. And usually one lot of 50 would go for the same amount that we paid for at 1,000. So that was I always say that's kind of my introduction into being an entrepreneur. But then from there, at the age of 14, I started an online marketing business and spent a lot of my early times in business in an online marketing industry. Eventually went to college and said, I need a backup plan. What happens if this online marketing stuff doesn't work? And that's where I said, I'm going to go to be an accountant, and eventually got the CPA. And just through time, it just made sense to start the accounting firm. So really kind of been my own business, been a business owner, been working for myself since very early on. Now, throughout that process, again, when we were doing this marketing firm, a lot of those companies I had partners with. Sometimes it was by myself, sometimes with a partner. And so I say a lot of that early on experience really helped me understand the business world a little bit deeper. I saw some massive successes in our business. I saw some big failures in our business. And I saw our business go through different life cycles throughout that process. So I truly think that experience has really helped our podcast and our firm understand kind of what cycles our business owners going through and how are we combating, how are we fighting those instances, because I've been through much of those in my own type of businesses. I think you're muted, Scott.
Well, I am muted.
There we go.
Look at that. Okay. As I was saying, I can relate to this. Um, as a starting business is concerned, when they're taking into consideration what they're going to license themselves as. Is it better to license themselves right away as a sole proprietorship or say like an LLC?
Yeah, so this is a question that always pops up, and it really just depends on kind of what are your intentions with the business. And so we always say, sole proprietorship is great for just getting started out, but ultimately down the road, you're going to want some type of entity structure there. So if you ask an attorney's going to say for legal purposes, you should probably start an LLC or a corporation or something like that. From a tax standpoint, a sole proprietorship and a single member LLC taxed exactly the same way. So there's no necessarily tax benefits by just opening an LLC, but it does formalize that process a little bit more. And then again, a business attorney might say, let's start with an LLC right away. The reason that we always say we want to have that LLC structure set up is one, because it creates that formalization. We have a separate business account, EINs, everything's kind of separated from our personal. And then the other piece of it is that if we want to look into an S corporation, I know we're going to be talking about S corporations a little bit deeper, but if we want to look at an S corporation down the road for tax purposes, we need to have an LLC structure set up. So we always say that LLC is typically be the foundation for your business. And as it grows, we're going to be doing different things with that LLC to help make it more tax advantageous. If we're just a sole proprietorship with no LLC, it kind of limits us as far as what we can do to customize that down the road, where eventually we're going to be going to an LLC anyways. So I traditionally say, what type of business is this? Do you have a wild idea and you want to just start something to see if it works? Maybe a sole prop's fine. Just get out the door. But as soon as you're like, yep, this thing's going to work, or yeah, we're gaining some traction, that's when I would make that move. If you're just starting out and you're like, I know we're going to be good, might not be making, $500,000 a year to begin with, but I know that this is going to be a solid business. We're going to plan to grow this. This is a solid idea. I would say, personally, let's start with an LLC right off the bat.
Great. Now let's talk about the SCorp side of this. Now, I know a lot of people, when they talk to me about what type of license or how did I license my taxing, they like to look at me and say, how did you do it? And for me, it was really different because I did start off as a sole proprietorship, and I learned a lot of lessons since then about why I probably should have started off as an LLC right away. And as we discussed earlier, it was hard for me to make a transition from a sole proprietorship to an LLC because I got used to taking away from my own personal account. Because as a sole proprietorship, you can add your personal account as your taxes come out of your identification for your Social Security, so it's attached to your bank account. What's the difference between a regular LLC and an LLC filing as an SCorp?
Yeah. And just before we get into that, Scott, I would say one thing too is that whether you're starting off as a sole proprietorship or whether you're starting off as an LLC, I would always have a separate business bank account. So even if you're at a sole proprietorship, you might not need to have a business bank account, but just open up another personal account that you're running all of that business activity through. It's key to always, in my mind, have everything separate because you're not going to miss deductions there. You're not going to commingle things. You're not going to miss something that could be a legal deduction for you simply because you have things commingled. So that'd be my first bet. No matter what you're starting off as a business, open up a separate bank account specific for that business activity and run all income expenses through there, whether it's a sole prop, LLC, S-Corp. When we look at an S-Corp is simply a tax election. An S-Corp is not an entity structure. It's just a way to be taxed. So with an S-Corp, you have to have an LLC or a corporation already set up, and then we're just electing for that structure to be taxed as an S-Corporation. So if you have an LLC set up, it remains an LLC. The name remains the same. It's just when we go to file taxes, it's an S-Corporation. Now, the big question is, why S-Corporation? What would be the idea? What would be the intentions of ever wanting to think about an S-Corporation? And for that, we got it's simply for a self-employment tax play. So for that, we kind of got to look at how is a sole proprietorship or a single member LLC. Again, they're both taxed the same way. How are they taxed? So with both of them, you're going to pay your normal income tax rate on whatever profit from the business is, just as if it's just normal income to you. But then with a single member LLC, you're also going to be paying self-employment taxes on 100% of your income. So if you make $80,000 a year, you're going to pay your normal income tax rate plus self-employment taxes on that full $80,000. And that self-employment tax is 15%, roughly. So with the S corporation idea is okay, how can we help eliminate or avoid a portion of that self-employment tax? And that's where this idea of an S corporation gets designed or brought up. Basically, with an S corporation, we're electing for your LLC to be taxed as an S corporation. As part of that S corporation, you need to pay yourself a reasonable salary. So as a business owner, you'd be paying yourself as a W-2 employee. It's like you're an employee of yourself. So with an S corporation, you need to pay yourself a reasonable salary for the type of work that you're doing. And then with an S corporation, it's now a completely separate business tax return. So we have a S corp tax return. There's going to be a K1. It's still going to flow through to your personal, but instead of simply filing a Schedule C, now we're filing an S corp tax return. Mm-hmm. So the two biggest downfalls of an S corporation is, one, we have to set up payroll. We have to run payroll to yourself as if you're an actual employee of your business. That includes payroll taxes, setting up, running payroll, doing all of that. The second downfall is that business tax return. So let's look at how they are taxed. LLC, just single member LLC versus S corp. Again, single member LLC is going to pay the normal income tax rate plus self-employment taxes of 15% on 100% of the income. With an S corp, we take that same business and we split your income into two pieces. Piece one is going to be that reasonable salary, that amount you're taking through payroll. And then the second piece is going to be an owner's dividend or a distribution or an owner's draw. Basically, just taking money from the business account and transferring it to your personal account. With an S corporation, you're essentially paying self-employment taxes on that salary piece. So that portion of income we take as a salary, we're paying self-employment taxes on. But that portion of income that we take as a dividend or a distribution, we're avoiding self-employment taxes on. So let's use that same example. Let's say we had $80,000 in profit. As a single member LLC, we're going to pay roughly, running quick numbers, roughly $12,000 in self-employment taxes. Mm-hmm. If we do an S corporation, we might say, let's take a reasonable salary of $36,000. We're going to pay self-employment taxes on 36, but now the remaining 44,000 of that 80, we're avoiding self-employment taxes. So we're avoiding 15% self-employment taxes on $44,000. And that's where the S corporation starts to make sense. Now, like I said, the S corp comes with some downfalls. Have to run payroll. That's a monthly cost. Have to file a more complex business tax return. That's going to be a cost to you. So that's what we say, when does an S corp make sense? Typically, we're saying once you hit profit of 50,000 or so, that's when an S corp is going to make sense. Below that, it's not necessarily going to hurt you. It's just some of the tax savings are going to get eaten up by those additional costs that you have.
Oh, I know that cost. I've been there before. So I was, as you know, last week I got the privilege of sitting with Matt Ruttenberg, and can we fold some of the we pay ourselves our checks, that extra amount that's left inside the business account, can we fold that into, say, like a 401k and itemize that as a deduction?
Yeah, so there is a way to, and Matt's been great. He's been on our podcast as well. When we look at retirement, that's where we got to pick out what type of plan is going to matter to you. And as Matt probably talked about, whether you have employees or not employees is kind of the first step. If you have no employees, we're looking at a solo 401k or a SEP IRA. Now, when we do an S corporation, that retirement amount, the amount that we can contribute to retirement, is going to be based on our salary. So if we do a SEP IRA, for example, that's going to be limited to 25% of our salary. So if we look at a sole proprietorship or single member LLC, that's going to be the typical amount for a SEP is going to be 20% for a single member LLC. So if we're making $80,000, we can put $20,000 into a SEP IRA. With an S corporation, now we're limited to 25% of our salary as a maximum. So if we're lowering our salary now to $36,000, the max we can do is 25% of $36,000. And so that's oftentimes when we're going to look at a solo 401k. If someone's looking to max out retirement, we're going to look at a solo 401k with an S corporation because it allows us to max out quicker. Because with a solo 401k, you have an employee contribution, which you can contribute up to 19,500. And then we have the employer contribution, which is 25%. So with a SEP, it'd be 25% of total salary. With a solo 401k, we can do 19,500 plus 25%. So that's why with no employees, we're typically, if someone's looking to max out retirement, we're going to go towards that solo 401k route versus a SEP IRA route.
Well, thank you for that answer. Sorry here, I'm stumped on words today. So let's talk about normal questions that come out of me when I first started were bookkeepers, CPAs, etc. Would you say that those are probably the first people I should probably be hiring instead of employees, is to get those people right off the bat? So, like, in other words, trying to do it on my own as a bookkeeper, I found that's kind of hard because I have to go over there and spend a whole day just trying to catch up on my books, and there might be loopholes that I don't know about that a bookkeeper might, and they communicate better with you guys when it comes to that. So is there a bonus half about hiring them early in the years of first starting your business, or is it better to wait until you're, say, like starting off the SCorp?
Yeah, I would say, hiring an accountant or bookkeeper or a tax advisor early is probably a good idea. And most of the times, the pricing for that is going to be based on your business size. So as you're just getting started, that cost is going to be, on the lower end. As your business grows, obviously that's cost is going to grow with it. So I would say, getting that accountant in early is going to be nice, because then you have a complete set of financials. We always say bookkeeping is kind of the backbone to your business. And so if we get that set up right from the beginning, we know it's set up, and that's going to just help exploit your business growth. Now, we'll say when we talk about an S corporation, one maybe additional downfall is that with that more complex tax return, we need a full set of financials. So we need an income statement or a profit and loss along with a balance sheet. And that's part of that bookkeeping piece. And so I would say for any business, whether you're a sole prop or S corp, you should have both of those financials either way. And so it's important to have them anyways. But with an S corp, it's even that much more important. So if you get in with an accountant at the beginning, you're going to have an income statement, you're going to have a balance sheet, you're going to have clean and accurate books. That's going to be the foundation to your business. And then as you grow, maybe get into an S corporation, add employees, do other things. We're just adding that onto bookkeeping that's already completed. We're not having to get someone says, oh, I want to do an S corporation, but bookkeeping's a mess. We might have to even redo all that stuff to begin with when we're paying for it anyways. Why not get started on the right foot to begin with? That's why typically we're going to say, get connected with an accountant at the beginning. Now, one thing that we have as part of our podcast is our tax minimization program. This is a kind of do-it-yourself type program. And so on that program, we teach people all sorts of tax strategies, implementation guides. We do monthly group trainings. We deep dive into specific tax strategies. And we also have a bookkeeping training as part of that. So a lot of clients, I might say, you might be really good at bookkeeping. You might have done this in the past. You might have ran a business, and this is something you feel comfortable with. Go through something like that. Go through a program like that where we can teach you how to do your bookkeeping. We can teach you tax strategies, how to implement them, everything you need to do there. And then you can use that in the beginning. And then when you're ready to say, hey, now I need an accountant, or I no longer want to do this myself anymore, now we can upgrade you and say, okay, let's move you to done for you services instead of you handling that yourself. So I will say not every business owner needs to have someone doing their bookkeeping. Although most of the people that come to us that we see should have had someone do their bookkeeping, or at least had done some training, because they're just not as advanced as that they are. Now, sometimes we see books come in great, perfectly clean, that have been done by the bookkeeper, and that's perfect. There's no problem with that. Again, it's just kind of where you are at your level of expertise in that area.
How far do you figure your level of expertise is by now?
Too far. It's funny. In our business, my focus now is as far as my specific role is to focus more on that tax planning piece. How can we make sure that people are paying the least amount of taxes legally possible? And as part of that, we have our podcast and our free content. And then we have our tax minimization program, which is, again, that deep dive, which is more of a subscription program. And so I would say my experience in that area is really good. But now I'm no longer preparing tax returns personally as often as I used to. And so you start to lack in some of those areas as well. And that's also why having a great team behind you is good too. So, tax planning, really good at. Now, when I look at some of the tax preparation, I myself are sometimes a little bit rusty because I'm not doing it every day. But, it's some of those things that you catch on so quickly once diving into it. But again, that's kind of this idea of creating a team around you, making sure that you have a full set of team that's going to help you in this business journey. Whether that's an attorney, whether that's a retirement plan specialist like Matt, whether that's an accountant or a tax advisor, just making sure that you're adding or at least vetting those people so that when the time is right, we can plug and play them into your system.
Now I know you got a couple of events coming up. I think you got one next month and one in June, right?
Yeah, we have a free webinar coming up in May 4th, and that's our 2020 tax strategies webinar. So we're going to be talking about some of the main tax strategies that you need to know for 2022. And so that's coming up again May 4th. You can sign up for that at taxsavingspodcast.com/webinar. And then we also have our Small Business Tax Savings Summit. This is going to be a 2-day event where we go through a full 2 days of everything basically that business owners need to know about tax savings. We're going to show them about S corporations. We're going to talk about different strategies, how to implement them, the retirement side. And it's basically a full in-depth 2-day event. And so that's called our Small Business Tax Savings Summit. That's June 14th and 15th. This year, we're doing it virtually. And if anybody that's part of our, either a client of ours or part of our tax minimization program, that summit is included. Otherwise, if you're just like, no, I just want to check out the summit, no problem. You can also register for the summit only. So our summit is taxsavingspodcast.com/summit. That's June 14th and 15th. And then our webinar talking about 2020 tax strategies that you need to know. This is a free webinar. That's going to be May 4th. And again, taxsavingspodcast.com/webinar to sign up for that one.
Great. Anybody that is paying attention to our YouTube or our podcast, I'll make sure that I link those notes down at the bottom in the information tab, as well as the show notes. What do you feel is the differences between marginal and effective tax rates?
Yeah, so this is where a lot of people get confused. That they feel like, oh, if I jump into that next tax bracket, that all of a sudden now I'm paying higher taxes on all my income. And so that's what we call marginal tax rates. And basically that's what tax bracket you're in. What's your marginal tax rate be? Which bracket you're in. And how the US system works is it's based on certain income. So, 0 to X amount, you're in this bracket. That amount of income will always be taxed in that bracket. And then any income from that level forward is taxed at the next bracket. So if you jump into a higher tax bracket by $1, that means that you have $1 being taxed at that higher rate, and the rest of your money is being taxed at a lower rate. So that's kind of that marginal tax rate. What bracket are you in? When we look at effective tax rate, that's what effectively, how much taxes are you paying on your total income? And so that's going to be a much lower number typically because it's the accumulation of all those different tax brackets and the income at those tax brackets. So lomeone might be in a high marginal tax bracket, but because of deductions and everything else, their effective rate might be much lower based on the type of tax planning and things that they're doing. Not to mention also that much of that income is going to be taxed at lower rates, not that higher rate. Only the amount over a certain amount is taxed at that higher marginal rate, if that makes sense.
Mm-hmm. Now, as a sole proprietorship versus the LLC part that you were talking about before, I wanted to specify on some of the things that I learned before, and maybe you could correct me if I'm wrong about these. I found it a lot easier to separate my taxes during the year. Instead of waiting till the end of the year during sole proprietorship, it was always easier for me to pay it every quarter. Do you feel that that's adequate to keep that kind of choice going for maybe somebody new coming into the field?
Yeah, absolutely. Especially new people. This is where people get all sent into a tax snowball, where the IRS is a pay-as-you-go system, so a pay-as-you-earn system. So as you earn money, you owe taxes on it. Many people think that, oh, you just pay at the end of the year. No, actually, as you're earning money, you're supposed to be paying taxes on that income. And so that's why when we look at a W-2 earner, someone that's worked for someone, that's why there's taxes withheld from your paycheck, because you're earning money and your employer as a benefit to you is pulling those taxes out and sending them to the government. The end of the year is just a reconciliation saying, okay, here's what I made. Here's the tax payments I've made. Do I still owe a little bit or do I get a refund? And so when a new business owner comes up, they're so used to having taxes pulled out. So they might go that first year, they're not going to set any taxes aside. All of a sudden they go to file their tax return and here's a big tax bill. And so that's why we always recommend quarterly estimated taxes. And the key thing about that is going to be bookkeeping. We need to know what level of income are you doing? What's your profit and loss? By having that, now every quarter we can say, okay, our profit for Q1 was $20,000. Let's send in an estimated tax payment for quarter one based on that $20,000. Now we revisit it again for quarter two, and now we're up to 35. Well, let's make that an estimated tax payment for the difference of that. So that's where you're paying these taxes every quarter throughout the year. So at the end of the year, when you file your tax return, you're maybe paying a little bit if you didn't pay enough, or you're maybe getting a refund, but you're not paying a big tax bill. And there's also going to be no penalties or interest for underpayment of that. So yes, we'd always recommend paying quarterly estimated taxes. Now, some people might say, I don't know how to calculate those or anything like that. And that's where we'd say just take a percentage of your income and just use that number. Either put it aside or make that quarterly estimated payment. If you don't make quarterly estimated payments, you might have some penalties and interest on that. It's likely not going to be anything too crazy, but there will be some penalties and interest if you're not making those quarterly estimates. So the key thing there is whatever your business is set up, make sure that we're keeping a separate business bank account that we're running all of that activity through. By doing that, that's going to make your bookkeeping easy because all we need to do is record all of your transactions and code them from that one bank account or separate credit card, whatever it is. But we're going to have everything in one area. That's going to make creating a profit and loss super easy. So yeah, I would recommend making sure that we're creating that separation from the beginning, no matter how your business is set up, running that profit and loss, and paying quarterly estimated taxes. And if you're not going to pay them, at least put the money away so that you're not in tax time getting hit with a big tax bill. Because again, that's where we see so many people struggle as new business owners because they get hit with this tax bill. They don't have enough money for it. So now they're on a payment plan. Now they're paying taxes on prior year taxes on a payment plan, but they're also earning money again now this year that they owe taxes on. So they're paying taxes throughout this year on last year's. Then when they go to pay next year's tax bill, they got a big tax bill again. And so it's this snowball effect that never really corrects. And we always see it in the first year. So we always say, get on top of that first year. Get your taxes set aside so that you're not creating that snowball effect as your business grows.
So that was a great way to explain it. I couldn't have explained it even if I wanted to like that. So as I was explaining earlier, I've been paying attention to some of your podcasting, and most people that know me know that I did something in the last 4 years that's made a big drastic change in my life. And during your episode in November 24th of 2021, you sat with a gentleman and talked about a topic that I thought was perfect for me, perfect for my situation. That is, what is cost segregation? And I was hoping maybe you could explain a little bit of that on our podcast today. So can you explain what it is and how does it work?
Yeah, and just so everyone knows, on the Small Business Tax Savings Podcast, our idea is to present every week a strategy that you can implement. Some strategies are going to be like, yeah, this is for me. Others are going to be like, maybe not for me, but at least you're aware of it so that if that time comes up, it's aware for you. And so when we look at tax strategies, we have what we call baseline tax strategies. These are going to be strategies that are easy to understand, easy to implement. These are things like doing an S corporation, setting up a retirement plan, hiring your kids in your business, making sure you're taking advantage of every single deduction available. Easy to understand, easy to implement, available income at any income level. Then we have something called advanced tax strategies. These are going to be a little bit more complex, sometimes have some cost involved with them, and are going to be a little bit harder to understand. And depending on the type of activity that you have, you may need to have a little bit of a higher income to implement them. So the cost segregation study is something we might talk about is more that advanced planning. This is going to be where we look at a rental property and we find ways that we can depreciate that rental property quicker. So traditionally with a rental property, we're going to depreciate that over X amount of years, and we take it as just a building. So we buy a house that's on, or let's say we buy a fourplex. We have the cost of the building, or the value of the building, and then we have the cost of the land. The cost of the land is not depreciable, but the cost of the building is. And if we just take that building and lump it into one depreciation, we're going to depreciate that over many years. What a cost segregation study does is it says, let's take out the guts of that building and see if there's certain things that we can depreciate quicker. Can we depreciate the plumbing quicker because it's not as a long term as a full building? Can we depreciate the flooring? Can we depreciate electrical work? Whatever it might be, the cost segregation study is looking at the guts of that building and saying, this piece we can depreciate over 5 years. This piece we can do bonus depreciation on and depreciate 100% in the first year. And so instead of spreading out a depreciation deduction over 27 years, now we might have a bulk of it being done in 1 year, in 5 years, in 10 years, and then just the remaining part going out to 27. So that's kind of the idea behind a cost segregation study. Again, a cost segregation study is going to be a little bit more complex. They're going to have some costs involved with them. And so we often say that's kind of more of an advanced type strategy if it fits your needs. But it's a great example of something we do on our podcast. We have, sometimes it's just me talking about tax strategies, baseline or advanced, whatever it might be. Sometimes we bring on an expert. Cost segregation study is that area. I don't do cost segregation studies, so I'm going to bring on somebody that does them and knows them really well, that can tell our listeners kind of what they are. Same thing with retirement planning. I know retirement planning, but I don't set up the plans or know them that deep. I know the tax strategies behind them. I don't know some of the nuances of the actual retirement plan. That's where we bring on someone like Matt Ruttenberg to come on and say, here is kind of retirement options available to you. So that's our goal with the podcast, is again, just to try to provide every week a tip that's valuable to small business owner, regardless of your size. Sometimes the tip's going to be maybe for a higher income earner. Majority of our tips are available for anyone making any money up until people making millions of dollars.
Well, I'm always looking forward to the millions of dollars, Mark. Are you not?
You will get there. I promise.
That's great. So we're getting down to the nitty gritty of our episode right now. So I've got to ask you a couple questions that I normally ask all of the people that I have on our episodes, and I'm going to start off with one of my favorites, and that is, in your location, where are you from?
I'm located in Milwaukee, so Wisconsin area.
No kidding. So in your location, what is the hole in the wall spot that's the greatest to eat at?
Oh gosh, that's a great question. There is so much good food in this area. Um, I live in the suburbs, and so there's a lot of just kind of small restaurants in the area. One of my favorites is called Joe Mama's. It's in a small suburb of just kind of a dive bar type restaurant that makes great food. But there is a downtown Milwaukee. There's a German restaurant. Been there forever. There's presidents that would have meetings in Chicago and drive up to eat at this German restaurant. I'm not a huge German food fan. It's good, but I went there once and it was really good. And I think it's called Maders, Maders. And so it's kind of like a staple to Milwaukee. It's been there forever. Very famous people have gone there. There's pictures of them all over the wall. So if you're visiting Milwaukee and just want to try to find out kind of what is that secret place that's been here for a while, I would check out Maders. If you get to the outskirts, check out Joe Mama's. They make great food and excellent mac and cheese nachos.
I'll get to tell them that you're the one who suggested their businesses right there.
There you go.
So my next question is, this is absolutely my favorite question. It gives my listeners as well as myself something to think about or something to listen to while we're spending our whole week working our businesses. And that is, are you reading a book? And if so, what's your favorite book?
Yeah. So for small business owners, one of my favorite books that I read a long time ago is called The Millionaire Fastlane by MJ DeMarco. Now, what you're thinking of, this Millionaire Fastlane, is not kind of what you think of, what you're going to expect in this book, but it's a highly recommended book that has helped me early on in my entrepreneurial journey. I think I read it at the age of like 19 or 20. I actually had the opportunity to interview MJ DeMarco on our podcast last year. And so it's kind of that full circle many years later after reading his book and kind of basing a lot of the decisions I made of some of the learning that I've had there. to kind of connect with him again. So Millionaire Fastlane by MJ DeMarco. It's a very quick, a very easy read, but I think it's just very motivational to help people understand the potential that's out there and how to grow your business. It doesn't have to. You can make a lot of money doing various different things, and I think this book really kind of helps give you that motivation that says, if this guy can do it, if this person can do something like that, I have the potential to do that. It's not about being the smartest person in the room, being the best at what you do. It's all about just growing your business with that mindset of what's available for you out there.
Great. So I just want to bullet what we put together for today, and if I miss something, make sure that you hit it up and point fingers at me. So, uh, ladies and gentlemen, when you're writing your business plan, I always tell everybody in the entire world, if you're going to own a business, at least write a business plan. Write something that's, even if it's a jot on the wall, you want to make sure that you're writing it down or putting it on a post-it note, something that's going to build you some structure about how you're going to run your business. So our bullet points for today are going to be, if you're going to run your business and you think it's going to be something that you know for a fact is going to draw a business, you know for a fact it's going to bring in lucrative money, your option may be to own and get right into the LLC side. If you are just testing the waters and you're not sure how much money you're going to make right away, try doing a sole proprietorship. Make that into your business plan. And as you place that into your business plan, ultimately make sure that you place in a good bookkeeper and a good CPA. I highly suggest that bullet, especially for those reasons. They're going to give you insight about ways that you'll be able to work with your business, and they'll give you financial advice about where you should put your money and how you should place it there, so that way later on in the future, when you are talking to a tax accountant and they are looking for those ways to place your money the right way into taxes, they'll already have structure set for them. I want to thank you, Mike, for coming onto our show, and I look forward to having you again. Maybe we can do some more deep talks about maybe some ways that we can structure our taxes better. And I hope you have yourself a wonderful day. And this is Scott Scott for Small Space for Young Entrepreneurs, saying thank you very much for stopping in and listening to us. And I look forward to seeing you guys next week.
Thanks, Scott. Thanks for having me on. It's been a pleasure.